Okay, welcome everybody to Finance 231. This is week 3, and that means good news is you're over halfway through the course. Bad news is you're over halfway through the course. What do I mean? If you're caught up, you feel great, right? Just one more full week of assignment, assessment, discussion board, and then the last week you just have your final, and you're over halfway done at this point if you're caught up. If you're not caught up, it's time to get caught up. We just got the rest of this week and next week, and that's it. Just to remind you all, you can turn things in late for most of the credit, so don't get discouraged, don't give up. Make sure and turn everything in. You can still pass the class by doing that. But don't let yourself get so far behind that next week, you run out of time, because that Saturday next week, right, we talked about in week 1, is a hard cutoff. So I can't accept anything after Saturday at midnight next week for the course. Once the course is over and ended, we can't submit anything else. Okay? So just as a reminder, late work is accepted all the way up until next Saturday at midnight, and then that's a hard cutoff. Thank you everyone for participating tonight. I think I mentioned to the participants before I started the recording that if we can get 4 or 5 people to show up, maybe Tuesdays are better. I'll think about that. We'll see if I'll let you know if we switch it back to Monday. I'll announce it either way to let everybody know either way. So any of you on the East Coast with the recent snowstorms, or are we all in the West and Midwest? They've been getting hammered out east, and so I just wondered if anybody's Texas is okay. I hear not getting killed like Virginia and Washington D.C. area and Massachusetts. All those East Coast states are getting beat up. And then Diana in Idaho, you're like me here in Utah. We get beat up all the time, and we can take it, right? Spokane in sometimes the snow, sometimes the rain up there. Beautiful area. So anyway, just curious. Sounds like to me that most of us are in a similar time zone or even earlier, so that's good. It's not too late where y'all are at. So we want to cover a couple different things tonight. We always cover the assessment. This week's assessment is the week 3 assessment. It's not comprehensive like the last one. It's not a midterm. It's not a final. It's just over the material for this week, which if we had an ebook would be chapters 5 and 6 of the ebook. I'll post the slides. I'll go over a lot of the slides this evening, so you should feel comfortable when we go over the assessment topics that you at least know what to expect for the test. Last week, we've got all the grading done. Everything that you've turned in on time from week 2 is graded, and you should have feedback on it. If you have any questions about your grades on a discussion board or an assignment, you're welcome to shoot me an email. Sometimes I make mistakes, so double check the feedback, double check if there's an opportunity to increase your score by resubmission or editing or adding some content. Sometimes we just don't get full credit because we don't get all 3 posts, or we don't get 750 words when the assignment clearly states that that's the expectation for full credit. So I always encourage you to resubmit if that's the case for additional points if you'd like to. Your effort, I'll go ahead and reward that additional effort with some additional points. Okay, I thought the discussion board last week was awesome. This week I'm excited. It's a great topic. The whole idea of efficient portfolios is a significant area where advisors and even online programs are adding value for individuals. So most of us, and I speak even for myself sometimes, get caught in a situation where if we were trying to build our own portfolios for investing, whether it be at E-Trade or whether it be in our 401ks, most of us would struggle to make sure that allocation is well diversified and well allocated, both diversified and well allocated. And I'll go into what the difference between those two is later on tonight. But most of us don't have the wherewithal to analyze our investments and make sure that we're always well allocated and well diversified. So efficient portfolios is a very important concept, and the easier that online tools can make it for us to be efficient, the easier that our 401ks can make it for us to be efficient, and the easier that our advisors can make it for us to be efficient. They do us a favor when that happens, because efficient portfolios are going to maximize return for the amount of risk that we're taking, which is what we're all seeking, right? For the risk we're willing to take, we want to maximize the amount of return that we can get. All right, so that's this week's discussion board. Should be interesting. and I hope it turns into a good discussion like last week about internet investing. I thought everybody did a great job. I only had one, maybe two people who didn't participate on the board last week. So I felt very good out of a class of 31, participants, that we had almost everybody participating, almost everybody giving feedback and opinions. I thought it was a great board. So appreciate your efforts there. Still had a handful of folks who didn't turn in the assignment last week. If you find yourself in that boat, don't stress. If we've got a couple assignments to get caught up, don't stress. You'll be able to do it. We're only talking about 2 or 3 pages in content to get to that 750 word requirement. And if you just research a few different places online about the concept or about the topic from week 1 and week 2, you'll be in great shape. Okay. Any questions about the coursework up to this point, about grading, about the discussion board for this week, any of the stuff that we've covered so far? Concerns, questions, issues we need to cover? Okay. Just zip them into our group chat there. If you do come up with anything, you might come up with something later on and think of something that you were worried about or that you're concerned about, and just write it right in, no matter where I'm at in the course, and we'll cover it. So what we'll do tonight is we're going to spend a few minutes here at the very beginning talking about this week's assignment, okay, which is to answer some short answer questions about Starbucks. And hopefully it doesn't make some of you just crave coffee. For me, I'm not a coffee drinker, so it doesn't get me excited at all. But I realize for some of you, you don't need an excuse to think about coffee because it just makes you want to go get some. So hopefully that's not the result of this week's assignment. But this week's assignment shouldn't be hard. And tonight, I will go ahead and help you find the information that you need to find in order to complete the assignment. So should be well on your way to answer those short questions and feel comfortable that it'll take a little bit of digging and poking around online, but you should be in great shape. Vince, are you an at-home brewer, or is there a different place you'd like to go? You're one of the few. Like I say, I'm not a drinker, but a lot of people say, yeah, they love Starbucks. So, all right. So, a couple things we need to address about the assignment. First of all, as far as the writing requirement, I'm not going to be as concerned about the writing requirement this week. Now, having said that, that doesn't mean I want 2-word answers to all the questions. There are about 10 or 15 questions as part of the assignment, and I expect full sentence, full thought, well thought out answers. Doesn't mean that it has to be a paragraph or 2 paragraphs or 3 paragraphs long. They're meant to be short answers. However, short answers doesn't mean 1 word in most cases. It means a couple full sentences about the content and represent the fact that you've done the research, that you've looked up the information, so that I can tell some effort was put in. Okay. Any questions on this week's assignment as far as the content requirement? Like I say, I'm not going to count your 750 words like I have been the last 2 weeks to make sure I can give you full credit, but I do expect a short explanation. Exactly, Vince. Not a paragraph, not a full paragraph necessarily. Sometimes it might require that, but in most cases, just a few complete sentences. Okay. And then there may be exceptions to that. For example, one of the questions asks what the Starbucks ticker symbol is. So what is the symbol in the stock market for Starbucks? Can anybody tell from the screen that we're looking at now what the symbol for Starbucks is? And this would be an example of a question, that you don't need to give a couple sentences, right? If it's asking for the symbol of Starbucks, Diana, you got it absolutely right. It's SBUX, okay? Where did she find it? She found it after the Starbucks Corporation name at the top of the screen on the top left. Right below that, you see NASDAQ. That's where it trades, is on the NASDAQ. And then right next to that colon is, it says NASDAQ colon, and then it gives you the symbol for Starbucks. Now, I'd like to just take your attention real quick. This isn't software that I have because I'm a financial advisor. This is a Google search, right? I put Starbucks stock in the search bar, right? So nothing secret here, nothing crazy, nothing hard. This week, all you need to do to find all the information you need to know is exactly what I just did, which is search for Starbucks stock on the Google, on a Google search screen. So it'll get you to this main screen about, the basic information of Starbucks. If you scroll down a little bit underneath the chart, okay, underneath that chart, almost too small for you to see, it'll say Google Finance, Yahoo Finance, and MSN Money. You might not be able to see those. Can you all see underneath the chart, right underneath the chart, Google Finance, Yahoo Finance, MSN Money. Okay. So what you're going to do, and you can use any one of those three, but you're going to click on one. My personal preference, I like Yahoo Finance. So I click on Yahoo Finance. Okay, you'll notice it brings me to a next screen, basically a summary screen about Starbucks stock. Gives me the price that it ended at today, $58.61, which represented a 90-cent gain today in the market for just over 1.5% in value change. It shows me a chart on the right side of how it looked during the day. That's the chart of the up and downs throughout the day. But I can look at the 1-year chart, the 2-year chart, the 5-year chart, the max, which is just the longest period they've been tracking it. I can find out things from this screen like when they're going to come out with their earnings next, which will be April 21st. Okay, that's the next time they're going to come out with their quarterly earnings. I can find out what their dividend rate is. Who can tell me what their dividend yield is? How much are they going to pay me for owning this stock? What percent dividend yield are they going to pay me for owning Starbucks stock? Can anybody find that? Yes, 1.35%. Good work. So if I own Starbucks stock, no matter what the value does as far as going up and down, and it's definitely going to go up and down, all stocks do, they're going to pay me 1.35% a year to hold that stock. Okay? So if I own one share, which would be about $58, right? I'm going to get 1.35% paid to me on that $58 every single year that I hold it. Okay? Most of the time, dividends don't change dramatically. Sometimes they do. Okay? Most very large, well-known companies don't change their dividends very significantly very often because investors like them to be consistent and predictable. So they usually tend to keep their dividends the same or slightly increase them year after year. Okay? Does anybody know what the national average for a savings account is right now at a bank? What's the national average for a savings account at a bank? Just a regular savings account. And this information might have been updated over the last 6 months, but sometime over the last 6 months, I was reading an article and said the national average of the large banks, of the big banks, for a savings rate right now is 0.2%. Okay, 0.2%. So you get 1/5% on your money if you hold it in the bank in a savings account. So what I like to encourage people to consider is the fact that there are a lot of large companies like Starbucks, like others, Walmart, ExxonMobil, AT&T, Verizon. There's lots of companies that pay us a lot more than a savings account to hold the stock, right? That's an actual dividend. That's like interest that you're going to get every year for holding the stock. Okay? Any questions about dividends and stock on stock, dividend yields on stock? Okay. On the far left of your page here, you'll notice a bunch of different tabs, right? Bunch of different hyperlinks over here. Stuff about news about the company, different quotes, more chart information. I can look up all kinds of information, general information about the company. Okay? I can find out information about what analysts think about this stock. And then I can find out about what insiders are doing with the stock. If I scroll down a little bit more, on this page, you'll notice I get to financials. Okay? There are 2 or 3 or 5 or 6 questions, I'm not sure offhand, that relate to Starbucks financials. And most of them relate to 2014 financials because that's when whoever wrote the assignment wrote it. Okay? But that's okay because you can go into the financials and actually look back at past financials. You don't have to just look at 2015. You can look at 2014 or 2013. You can look at quarterly instead of annually. So let's just take a look at that really quick to give you an example. If I look at their income statement, you'll notice it shows the income statement, and they've got their corporate year, okay? Their fiscal year is from September to September, right? That's why they show these period ending years. And there's 15, 14, and 13, and then the information on their income statement. If I click on this hyperlink up here under the word income statement that says quarterly data, I can see the quarters over the past 4 or 5 quarters, a quarter at a time, and their income statement. I can do that for the balance sheet. I can do that for the income statement. I can do it for a cash flow report. Okay, so that'll help you with the different questions this week on the assignment. Christine, about your question about buying more than one stock, yes. And I just gave a quick example of just buying one share of Starbucks because it's an easy example. But I could buy hundreds of shares of the stock, or I could buy, I could put $100,000 into Starbucks stock. Okay, and if I did that, then I would get paid, like I say, just about 1.5% per year for having it, the dividend, or 1.35, excuse me. Okay. You can buy as many shares as you want, as many shares as you can afford, right? Because most of us are constrained by how much money we have. We can't buy unlimited amounts because we just don't have the money to do it, right? Even big institutions and mutual funds are constrained by some kind of, amount of money that they can't invest too much in. Let me just give you one more example of a stock, just because I think it's an interesting exercise. And tonight we'll be talking about common stock. So it's highly applicable to chapter 6, which is the second chapter we'll cover tonight. First chapter, we'll be talking about efficient markets, efficient portfolios, right down the line of what you're going to be doing for your discussion board this week. And the second chapter is all about common stocks, and what are they, and how do they work, and how do you trade them, those kind of things. Okay, so here is AT&T. Okay, same report. And this is, anybody can look up any stock you want on Yahoo Finance and find all the same information. But you'll notice very quickly on this particular stock, AT&T, the company that does wireless, okay, what is their dividend yield? What percentage are they paying if you hold their stock? Yeah, significant, right? There's not any CDs, there's not anything you can go and buy from a bank, right, that will pay you even close to 5%. But yet, a big company, AT&T Wireless, is willing to pay you 5.5% if you own their stock. So there are a lot of folks right now who are buying big company stocks so that they can get better interest than what they get from the bank. And AT&T is a good example of one of the companies that people buy a lot of. Okay? There are lots of companies like that. I just thought I'd give you an example. This week's assignment, I think, just is only about Starbucks, so you won't need to research other companies. But it's really easy to look through different companies, and so I'd encourage you to poke around a little bit and do a little bit of research on your own. And like I mentioned last week, if you're interested in starting investing at some point, but maybe you don't have money now, you just want to learn about it, or you do have money but you don't want to get it straight into investing and risk losing it, a good way to kind of do the in-between is to go to Investopedia and do one of their simulators, okay, their stock simulators, where you go in and trade play money, right? And you can just practice trading into different stocks. You can practice trading out of them. You can practice watching how they do over time, so you get a feel for it. Okay? All right. Let's go to slides. Any questions about this week's assignment before we move on from the assignment, the research about Starbucks, and go into the chapters? Everybody feeling okay about this one? Okay. So let's look at slides from chapter 5. We're going to be talking about modern portfolio concepts. And this is a little bit of a misnomer, a little bit misleading, because if I were to tell you something was modern, you'd probably think, like iPhones are modern, right? Because, it's relatively new technology over the past, 5 to 10 years, and it's highly technologically advanced, device. But when we talk about modern portfolio theory or modern portfolio concepts, we're talking about theories and concepts that were created in the 60s. Okay, so most times we'd be thinking modern portfolio theory is something that would have been in the last 10 or 20 years and developed. But when we talk about modern portfolio theory, we're talking about something that was developed in the 50s and 60s. Some gentlemen won the Nobel Peace Prize for their research. And it's added a lot to the investment community, but it's not necessarily modern anymore. It's just referred to as modern portfolio theory. Okay. So just know that we're dealing with concepts that were created 40, 50, 60 years ago, and they're concepts that have stood the test of time and have worked for investing, and so they're still, the most common thing for us as investment advisors and portfolio managers to use to create people's portfolios. Okay. Most people, and I've mentioned this to you before, don't want to pick their own stocks. They don't feel savvy enough or confident enough to go out and build their own portfolios, of investments. You've got people like Jim Cramer on CNBC every day at 4 o'clock my time that yell at people about how they should just build their own portfolios, buy their own stocks. What ends up happening for most of us is we don't feel confident and savvy enough to do that. There are some people who feel perfectly comfortable doing it and are very disciplined, and so it works for them. But most people that I run into are not comfortable doing that, and so they want someone or something like a computer program to help them create a good portfolio that's highly diversified, that has good positions in it, that they feel comfortable is going to grow over time. So what is a portfolio? A portfolio is just a basket, okay, not a literal basket, but a figurative basket of different investments. So if I have a portfolio of stocks, that just means I have a basket or a group of different stocks in my account. Okay. If I have a portfolio of mutual funds, I have a group of mutual funds. If I have a portfolio of bonds, I have a group of bonds in a portfolio. Okay. And there are two different objectives for portfolios, two different main objectives. Okay. One of the objectives is to get growth, and one of the objectives is to get income. And then there are all kinds of hybrid portfolios that do both, right, at some level. They might be a little more focused on income, but they also get growth. Or they might be a little bit more tilted towards income, but they still have some element of growth. Okay? And this goes back to what we talked about a little bit last week, which is when we invest, okay, the definition of an investment is something that we expect a return from, right? Do you remember that? The definition of an investment is something that we expect a return from. And what two components make up return? Does anybody remember? What are the two components that can potentially make up return, or two different categories of return? This is going back a few weeks, so this is going to be hard for someone to remember that far back. But the two different categories are interest or income. Okay, so that's one category. And the other category is growth or appreciation. Okay, growth and appreciation mean the same thing. Interest and income are the same thing. Okay, is that ringing a bell for anybody? So that's what we mean by total return is both the appreciation or growth of the investment and also the income or interest from an investment. And you'll recall that we talked about the example of a rental property. Okay, this is going to sound too easy, and I don't mean it to be patronizing, but what are the two components of investment return when it comes to a rental property? You got two different things going on with a rental property. You've got the income from the rents, right? People are paying you rental income. That's income or interest. That's one part of your return. That's exactly right. And then you've got another component of your return, though, too, and it's a very important one. It's the fact that your property value will increase over the long term, right? So let's say you buy a rental property today and it costs you $250,000 for a fourplex. Well, most likely, if we were to fast forward 20 or 30 years, that property is going to be worth a lot more than $250,000. So not only did you collect the rental income, right? That was part of your return. You also got the increase in the value of the property. So two different parts to your return. A rental property is definitely an investment because it's got both parts, right? And an investment can have either one of them or both. So Vince, historically, even if you're in a bad area, even if you're in a situation where the community is kind of in decline, if you go 20 or 30 years, you should have better value than when you bought it. Now, there are exceptions to that. So, for example, there are parts of Detroit, there are parts of New York, there are parts of Chicago where the values actually go down. And you can guess why, right? They become kind of slums. No one wants to live there. There gets to be a lot of crime. And if you have a rental in a property area like that, there is a potential for your value to go down. But 90% of the time, okay, over the long term, your rental property will go up in value, your investment will go up in value. You'll get a return from the increase in the value of the property in addition to the income that you receive in rents. So kind of a two-part return, right? We'd call that a total return, which includes both rental income and appreciation of the property. Okay, so that's a nice little review from week one, which was a long time ago, I realize. But now we're talking about portfolios, right? And when we talk about portfolios, you could say, you know, my focus, and I hear this every day from customers of the bank. They come in and they say, you know what? I just wish that there were CDs that paid me 3 or 5%. I just want something that pays me some income on my savings, right? I've worked really hard to save all my life, and now I just want my savings to actually get some interest. Okay, so they're asking for an income-oriented portfolio. They just want some interest income. Then I have other people who say, Dave, I'm young. I want to grow my money in an IRA or a 401k as fast as I possibly can over the next 30 years. You know, got a long time horizon. I don't need any money right now. I don't need any income. In fact, if anything, I'm going to add to this account instead of taking from this account over the next 30 years, right? I'm going to accumulate and grow it as much as I possibly can. Well, that would be, of course, more of a growth-oriented portfolio. Okay? And a lot of times it has to do with time frame and the need for money. If you've got a long time horizon, most people are more focused on growth. If you've got a short time horizon, most people are more focused on income. If you need income now, obviously you got to be more income focused. Okay, so sometimes your situation just dictates what you should do. But be aware that a lot of advisors don't even take the time to really figure out what is right for you. They've got kind of their sales pitch, and they're just going to sell you a growth portfolio every single time to every single person. Or they've got their sales pitch and they sell every single person they meet some kind of income portfolio. And hopefully you'd work with an advisor or a financial planner that would look at your situation and then give you advice for one of these types of portfolios that really is a perfect fit for your situation, right? So that you get what you're asking for as opposed to just what they're trying to sell you. Okay? So any questions about income versus growth portfolios? Any questions about what a portfolio is? Pretty straightforward, right? Okay, let's keep talking for a minute here about portfolios. So the ultimate goal of an efficient portfolio is this. We just want to get the most return for the amount of risk that we're taking. And we talked a little bit about last week about risk and return, right? We said in a perfect world with efficient investments, the more risk you take over the long term, you should get more reward. And in a perfect world, the less risk you take, you'll get less return, right? There's a risk return, what we referred to last week as the risk return trade-off. So if somebody comes to you, remember how we talked about this? We said if somebody comes to you and says, I can get you 20% a year guaranteed, okay? Your thought process should be, that sounds a little too good to be true, right? Because the only people paying guaranteed rates are the banks, and guaranteed rates right now are really, really low, okay? So if they're saying I can give you 20% guaranteed, there must be some kind of risk associated with what they're talking about, and you need to find out what it is before you even get close, to investing. Okay, so that's the risk-return trade-off that we talked about. In an efficient portfolio, we're building a portfolio that's highly diversified, and the objective is to just maximize the best return we can get for the risk that we're taking. And you might say, well, why does anybody even care about that? Why don't we just focus completely on return, right? Just give me the investments that give me the most possible return. And the answer is because most of us don't have the stomach for that type of investing. If you came to me and just said, I want the most possible return, I don't care how risky it is, I would say, well, let's talk through that. Because back in 2008, if you were taking a lot of risk, you could have lost 70% of your money. So if you invested $100,000 with me, that account value would have gone down to $30,000 if you were really, really aggressive in 2008. Okay? And if you're okay with that, that kind of fluctuation, then we're talking about the right thing here. You need to be really aggressive. But if you're not okay with that, which most people hesitate a little bit, right? They're like, oh, geez, I didn't know I could lose 70% of my money. It's like, yeah, if you're really aggressive, you could. Then they kind of pare it back a little bit and they say, well, what about something that's still aggressive but not that aggressive, right? And that's where you go through an exercise of trying to find what the right amount of risk is for each person that you meet with as an advisor. And for yourself, you need to know yourself well enough that you don't let an advisor establish your risk profile for you. You need to be the one dictating how much risk you're taking, right? You need to still be in charge of how much risk and reward you're trying to get from an account. And just know that there's always a trade-off like we talked about. Okay? Somebody already on the discussion board pointed something out that's very interesting and I think is very helpful. Efficient portfolios both maximize the return for amount of risk, and they also can say, I'm going to maximize or minimize the risk for a certain amount of return. So you can do the exact opposite, right? And it's still creating an efficient portfolio. I can go backwards. I can say my target rate of return that I'm trying to accomplish is 5%. What's the least amount of risk that I can take to get that 5%? Okay, that would be an efficient portfolio. Or I can say my target risk is very conservative. What's the most return that I can get for being really conservative? Okay, and both of those would come to the same end, which is we're trying to maximize the return for the amount of risk that we take. Okay? All right. And basically, modern portfolio theory just basically said, look, there's a mixture of bonds and stocks and different alternative investments that if you mix those investments together in a certain way, okay, based on history, it's going to maximize your return for the amount of risk you're taking. We can actually analyze how to mix your portfolio so that we get the maximum return for the amount of risk that you take. Okay, so this is something that can computer generate the optimal portfolio for us. We don't have to analyze every time and try to piece it together manually. It's something that we have software that helps create efficient portfolios for us. Okay. That's a horrible equation right there that you don't need to know. So let's talk about correlation real quick. So you've got a couple different forms of correlation. Correlation is just a statistical measure that basically measures the relationship between two different investments. And what we want in a portfolio is some negative or minimally correlated investments. And let me explain what I mean. If something's positively correlated, it means it tracks the same direction in the market, right? So that would be like having ExxonMobil and ConocoPhillips, two very large oil companies, and when one of them does poorly, they both usually do poorly. So those would be two highly correlated, non-diversified stocks, right? Or if I invested in Dunkin' Donuts and Starbucks, there would be some correlation there. Maybe not as much as Exxon and Conoco, but Starbucks, and Dunkin' Donuts would probably have quite a bit of correlation too. If people stop drinking coffee or stop spending on coffee, both of those places are going to get hurt by that, right? So there'd be correlation. The whole point of creating a diversified portfolio is trying to put investments together that are not correlated, or even better yet, negatively correlated, which means that when one goes up, the other goes down. Okay? Because if you've got those types of investments, then you're diversified, right? You don't have all your eggs in one basket when you've got things that have a low correlation, no correlation, or negative correlation. Okay? We just want to make sure that we're not putting a bunch of investments in a portfolio that are all positively correlated, because then our investment's going to go the same, all our investments are going to go the same direction. So we aren't getting any added value by having more than one investment. To get added value by having more than one investment, we need to be diversified, and we need to have investments that aren't all positively correlated. Okay? So that's how we start the building process of a portfolio. And back to my example of Jim Cramer on CNBC, every Thursday he does Am I Diversified call-in segment of his show. And he basically has people say, hey, these are the 5 stocks that I own. Am I diversified? And then Jim Cramer says yes or no, and he tells them why. And basically, it's an oversimplified way of saying, hey, if you've got 5 different stocks and that's all you're going to hold, make sure they're in different categories, right? Don't own 5 different airline stocks. Don't own 5 different tech companies. Don't own 5 different retailers. Have different categories of stocks so that you have less correlation, which is a positive thing because that adds to your diversification of your account. Okay, let's stop for a minute. I haven't heard from Diana, Christine, Annette, or Novina for a long time, or at all. Are you awake? Or do you have any questions, concerns, anything that you'd like me to? I know you're there. I just want to make sure that I haven't lost you and put you to sleep. I may have done that, but this is a good opportunity to wake you up and start over, right? So if there's no football game on tonight, right? Any Broncos fans? Any Carolina fans? Hopefully we don't have any Arizona fans or any Patriot fans, right? They both those teams got beat up this last week. Niners, huh? New coach there, Vince. All right, so we're all awake. We're all here. We want to make sure that we lower diversification so that we get higher potential maximization of returns and lower risk, right? Diversification reduces risk. And all of us want to keep risk at a minimum, right? Nobody wants to sign up for high risk just for the sake of signing up for high risk. If we can lower that, that's a good thing. Seahawks, that's been a successful group the last few years. Got your Super Bowl ring a few years ago. That's nice. All right. This talks about correlation coefficients, how something's positively correlated. It'd be like a +1. -1 would be negatively correlated, and 0 would be two things that have no correlation. So if you're looking at a correlation coefficient between two different stocks, which we have software that measures the correlation coefficient between two stocks, the closer to 1 it is, the more positively correlated it is. The closer to 0, the more non-correlated is, and the closer to -1, the more negatively correlated it is. And if I can find something that's -1, that's awesome, because it means that I'm really reducing my risk, because they're going to move differently or oppositely even. So here are some graphics that show you positive correlation versus negative correlation on two different stocks, M and N. So why does diversification work? Because when you reduce correlation, you actually reduce risk of the account, but still have the upside potential of the portfolio. So if I have a basket of large company stocks versus just having one large company stock, I have more risk protection or lower risk in that basket of stocks that are not correlated than I would if I just held a couple stocks that were correlated, right? And we're trying to always look at minimizing risk and maximizing return. This shows you the combination of assets. This shows you combinations of various correlation coefficients depending on what they are. High return to low return. Not something we need to look at. International stocks definitely do diversify us and add some diversification. So when we're building a portfolio, beyond just investing in different large company stocks, we should look at medium-sized, small companies. Those are referred to as mid-cap and small-cap stocks. So when you look at a 401k statement and you see mid-cap, small-cap, large-cap, all that's referring to is small company, medium-sized company, and large companies. Now you know. I'd say probably 90% of the population, when I talk to them about their 401k, they have no idea what mid-cap, small-cap, and large-cap means. So you guys are a step ahead of most people out there just by knowing that mid-cap, small-cap, and large-cap is just the size of the average company in that mutual fund. If you're in a large cap fund, that just means you've got very large companies like ExxonMobil's, Walmart's, the big companies. If you're in a small cap company, or small cap fund, you've got very small companies that can grow faster but also have more risk, right? So it's important to note what those are. So adding international diversification, adding emerging markets, adding natural resources, these are all things that can add potential diversification. Real estate, these are all things that can add diversification beyond just regular stocks or bonds. And the more we diversify, the more we protect our portfolio and reduce our risk. Okay, I think that's enough for chapter 5. So let's pull up chapter 6. Yeah. Oh, there it is. I can't find it. Okay. So here's chapter 6. I mentioned to you that chapter 5 is about diversification, is about modern portfolio theory and building portfolios. Chapter 6 is about common stocks. Before I get into what common stocks are and a little bit more about common stocks, know that common stocks are a basic building block of most investments, okay? So let's say you have a mutual fund portfolio or an exchange traded fund or ETF portfolio in your 401k or your IRA. Most of what those would be built on, most of those mutual funds would just be holding inside of them common stocks. Okay, if they're stock mutual funds. So it's a basic building block of a lot of the investing that goes on out there. Even if you don't have stocks, you probably have stocks inside of whatever you're owning, like mutual funds, whatever you have in your 401k or IRA probably has stocks in it. And for most people, stock investing sounds scary, sounds intimidating, sounds hard. With this new era of online, trading, online information, very easily accessible information, stocks are something that we shouldn't be nearly as scared as we are about anymore. I often hear in my business, stock investing is like gambling. It's like going to Vegas with your money. And I agree it's like going to Vegas with your money if you're not willing to do any research. I disagree that it's like going to Vegas if you are willing to do your research. Because if you do your research and do a little bit of homework, like Kramer talks about, then you put the odds in your favor. If you go to Vegas, the odds are never, there's nothing you can do in Vegas to put the odds in your favor. You will never have the odds in your favor. But with common stocks, you can have the odds in your favor if you do your research and do your homework. Now, it doesn't stop your stocks from going up and down, right? We know they're going to be volatile. But over the long term, out of all the different asset categories, real estate, bonds, precious metals, you name it, any of the categories out there that we could potentially invest in, if you look back 80 years, stocks outperform over a 10-year period of time every single period over the last 80 years. Okay, so stocks can be a great way to grow money. It's just that they're much more volatile than a lot of those other asset categories, and so a lot of people shy away, right? They're intimidated. They don't want to take on risk, but it's not risk of losing if you give stocks enough time. It's just risk of volatility, right? Because you won't lose if you give it enough time as long as they're good companies. It's just that you might have a rocky road. And, an example of that is the last 3 weeks. It's been a really rocky road for stock. It was a good day today on the market, but it's been a tough year so far in stocks. So anyway, it's a fundamental building block of a lot of different investments that you have. One of the things that I would say is when you're new to investing, especially in a 401k or IRA, I would encourage you to consider using mutual funds or exchange traded funds. And the reason for that is it just helps you to be diversified. Right? If I go out and buy Disney stock and then the next Star Wars movie is a flop, which I'm sure it will not be, I'm sure it'll be a wild success like the first one, like this last one was. But if it was a flop, Disney stock could go down 20 or 25%. It's not your fault, right? Disney's still a good company, but sometimes a headline or an issue like that can create problems for a company. Another good example, Apple is a great company, one of the largest companies in the world now. Apple's a great company that just came out with their quarterly earnings today. And in their quarterly earnings, they basically said we're not selling as many iPhones as we expected to. So what happens? Well, people were expecting that. And so over the last, if you look at the Apple returns over the last, 2-3 months, Apple stock is down like 20%. Is it because it's a bad company? No, it's because sometimes these headlines can move your stock in a direction that you wouldn't expect, and you just need to hold on and hold for the long term, and you'll be just fine. Like a Warren Buffett, what Berkshire Hathaway does. He holds on to stocks for the long term, but he buys good companies and then holds on to them, and he's been wildly successful doing that. Okay, so that's the way that you invest: is you buy something, you commit to it, you do your research, buy good companies, and then you hold on to them. Good times or bad. In fact, in bad times, you buy more. In good times, you might sell off some and take some profit, but you hold on for the long term. Okay, so what are common stocks? We talked a little bit, I don't remember if it was last week or the week before, about what stocks are. I mentioned to you that stocks can be referred to as equities. Okay, they can be referred to as equities, or they can be referred to as stock, like you'd normally hear. So if we say let's buy some equities, that would be saying let's buy some stocks. Okay, those two words can be used interchangeably. And why is equity the same as stock? Because stock, the definition of a stock is equity ownership of the company that you're buying. Okay, equity ownership of when you buy Starbucks stock, that means you own part of the company Starbucks. Okay, now how much do you own? 0.00000%, right? Some very minuscule number if you're just investing a few bucks. People like Warren Buffett that I just referred to can invest millions of dollars in a company, and then he might own 5 or 10 or 15% of that company, and it gives him quite a bit of power. For most of us, we don't have millions and millions of dollars to throw around, and so when we invest some money in a company, we're not getting enough ownership to be able to make any decisions for the company. We're just getting ownership that allows us to participate in the upside when the company does well, and participate in dividends that they pay out. That dividend that we talked about with AT&T and with Starbucks, it gives us the right to those dividends. It gives us the potential for upside. It also gives us the potential for loss. When you're an equity owner in a company and that company fails, then your equity ownership goes to zero. Okay? So a few years ago, when General Motors needed to get bailed out by the federal government when things were crashing back in 2008 and 2009, GM stock went down to zero. So if you'd invested in General Motors stock prior to that bailout, your investment went to zero. Okay? After the federal government bailed out General Motors, they restarted the stock and reissued new shares. But the people who had the stock before didn't get anything. Okay? So what is the risk of stock? The risk of stock is the volatility, of course, ups and downs. We know that's going to happen. We've talked about that. But it's also that the company that you own could potentially go to zero if they fail, if they go bankrupt. Okay, and it doesn't mean that the company is going to shut down. Delta Airlines has gone bankrupt twice, maybe even 3 times in its history. Okay, and it still exists, and today it's making really good money, right? Because oil prices are so low and they don't lower their prices. Dang it, on their airline seats. But the point is, you run a risk of a company going bankrupt at some point, and if your company does go bankrupt that you own a stock position in, your investment will go to zero. Now, how many companies go bankrupt every year? Of the very good big companies out there, very, very few. Of the small companies out there that are kind of speculative, lots of those go bankrupt every year. Okay, so we have to be careful how we're doing our investing. If we do our research, if we're diversified, if we stay with good names, it's very unlikely that we'll have bankruptcies. But it's not impossible, and it has happened at different times in history. Okay? All right, so those are kind of the main concepts I want to talk about common stock. Let me just click through some of these slides real quick. I'll be posting these, of course, like I do on the announcements so that you have them. Peel of common stocks, we've already talked about that. They grow, right? They pay us dividend income and they grow over time. And as an asset class or category, they've returned really well over a long time. Okay? So if we look at the S&P 500, which is 500 of the largest companies in the United States, if we'd have invested in those from 1950 to 2010, which is what this shows, your total return over that period, okay, your total return over that 60-year period would have been an 11% average per year over that 60 years. That means you're going to double your money, okay, that means you're going to double your money every 6 to 7 years over the last 60 years in the stock market. Okay, so that's pretty awesome when you think about it. Doubling your money every 6 to 7 years over and over and over again over the last 60 years in the stock market. Some decades were better than others, as you can see by those different bands that it shows. Okay, showing different stock prices. We don't need to go over a lot of these. Corrections are more than 10% decline. Bear markets are more than 20%. Right now, we're in the midst of a correction, a market correction, because the stock market went down more than 10% to start the year, but we didn't get into bear market territory, which would have meant that we were down more than 20%. So just the terminology, it's helpful to know. Then when you're looking at headlines, on the news, and it says, hey, the stock market is correcting, that just means that it's gone down over 10% from its previous highs. And statistically, we average almost one correction every single year. So if you think that a correction going down more than 10% sounds awful and you never want to have that happen, you can't invest in stocks, because statistically that happens every single year at some point during the year. But if you hold on to stocks, right, they historically have always recovered. So even though they have that up and down movement, they're going to recover and you're going to get your money back, as long as you don't sell when things are low and sell when things are bad. Okay? That's what we talked about earlier about being patient, strategic, as far as, saying, okay, I'm going to commit to these stocks for the long term. I'm going to ride the ups and downs. and my trajectory, my general direction is going to be good and positive over the long term, as long as I've got good companies and I'm diversified. Okay? All right. So those are some of the key concepts we wanted to cover. I do want to make sure that we cover the test. So let's skip over to that. Before we get to the test material, though, any questions, concerns about common stocks, anything that you wish you would have heard in the last 5 or 10 minutes about common stocks that I didn't point out? It's late. You're like, let's just get on to the test material. Yeah. Okay. So one of the things that you can do, though, is if you think of anything, any question that you have about stocks or any kind of investing, if you just think about it later, send me a quick email. I'd be happy to discuss it with you and just give you some feedback on it or show you where you can find more information about that. Okay? So anybody listening to the recorded session, or any of you all that just couldn't think of a question during tonight or didn't want to delay us getting to the test material, didn't want to be that person, right? You're welcome to zip me an email anytime and we can discuss. All right. So the test this week is only 10 questions. Okay, 10 questions, true, false, or multiple choice. So consistent with the format that we've had before, but more similar in its format to week 1, right? Because week 1 we just had 10 questions. So good news, bad news. Good news is only 10 questions. It should go pretty fast. Bad news is if you miss a few, you're not going to get the score that you want, right? So be careful on the test. Don't get tricked by the question. Read through all the answers. I mean, all the basic stuff for test taking that you've heard a million times, but it works, right? If you slow down, if you do your research before you get to the test, I mean, there's just things that work, about test taking, and I'd encourage you to do it. Number 1 on the test, you'll want to make sure. Novena, good question. Sometimes yes, sometimes you'll want to do some research online. So the first thing I would do is go to the slides and review the slide information about what I tell you the topic is. But every once in a while, you're not going to be able to take from the slides exactly what you need to know. And since you have the topic, I'd encourage you to just do a basic search and learn a little bit about whatever that topic is before you get to the test. Okay? All right, number 1 on the test says, basically wants you to understand what it refers to in the statement, a portfolio is less than the sum of its parts. So what does the statement mean? A portfolio is less than the sum of its parts. What is it referring to? Okay, what does that even mean? Sounds like somebody's trying to speak in a different language, right? Because that's not something we'd say around the dinner table at night with our families. A portfolio is less than the sum of its parts. However, it does have meaning when it comes to portfolios. So in chapter 5 that we reviewed tonight, we talked about how portfolios reduce risk, right? So the portfolio is less than the sum of its parts. It's the risk that's less than the sum of its parts. So if you were to take the risk of each one of the stocks that you hold in the portfolio and add them up, take the average of those, you would have a higher average than what the real risk is. Because the real risk, if they're not all positively correlated, is actually reduced, okay, by the fact that you have more more investments, excuse me. So the sum of a portfolio, as far as risk is concerned, is less than the sum of its parts, okay, the average of its parts, because each one of those investments is taking down the overall risk of the account, okay? So that's the concept. We talked about the concept, but you also need to feel like you understand that statement, because the test is going to ask you what that means, okay? Number 2 on the test. Well, it's not a true-false question, Novena. It's one that's going to have different choices for you to define what that statement means, okay? So you should be in good shape now that we've discussed it, but you want to make sure you understand what that statement means. Yes, it's a true statement, but for the test, you'll need to be able to pick out the definition of what that statement is referring to. Number 2 on the test, you're going to want to know the difference between positively correlated, non-correlated, and negatively correlated. Okay, so go back to those slides. What is the difference between positive correlation, negative correlation, and non-correlation? All 3 of those are a little bit different, and you'll just want to make sure that you understand the difference between those. Okay. number 3 is kind of that same concept. Does anybody remember which one of those correlations I said is the best for reducing risk in a portfolio? Is it positive correlation, negative correlation, or non-correlation? Negative. Yes. Thanks, Diana. So if I've got negative correlation in a portfolio, I'm really reducing my risk significantly. Okay. If I had 2 investments and they're perfectly negatively correlated, meaning they're a -1 on the correlation coefficient, theoretically that should mean that when one goes up, the other's going to go down just as much, so I'm not going to lose anything. Okay? But think about that for a minute. What does that do to your return potential? It actually makes your return potential null as well, right? So we don't want everything to be perfectly negatively correlated. In fact, if we can get things to be if we can get all of it to be non-correlated, then that's ideal, because then we can still get upside at the same time as reducing our downside risk. Okay, so if I'm going to put a bunch of investments that are non-correlated in an account, that preserves my ability to go up and at the same time reduces my risk some. Okay, if everything's perfectly negatively correlated, that reduces my risk, but it also reduces my return potential substantially, right? So just keep that in mind. If all I'm trying to do is reduce risk, negatively correlated assets are going to be the best thing. But if I'm trying to preserve upside, which I always am when it comes to efficient portfolios, I want just non-correlated investments. The best I can, I want non-correlated investment or slightly negative correlation, but not perfectly negative, or I'm going to reduce my return potential. So you'll want to know the difference between risk that I can diversify from and risk that I can't diversify from. So this is a topic in the slides from chapter 5. We didn't really cover it, but the bottom line is you've got risks that you can diversify and risks that you cannot. Okay? So if I invest in different stocks and I've got a very highly diversified portfolio, does that lower the chance of somebody doing an act of terrorism? No, of course not, right? So there are different risks out there that have nothing to do with my diversification. I can lower the risk of individual companies. I can lower the risk of a certain category having a bad time, or going into recession, but I can't reduce the risk of some global disaster, some natural disaster. I can't reduce the risk of inflation or taxes. Those risks are going to be there regardless of how I diversify, right? So there are risks that you can diversify through portfolio construction, and then there are risks that you cannot diversify from. Just make sure you understand that concept of diversifiable risk versus non-diversifiable risk, and maybe some examples of both. The slides do show some, but it's pretty intuitive, right? I mean, there are risks like terrorism that we know no amount of diversification really helps us, right? If somebody started World War III, it doesn't matter that we're diversified, right? Things are going to be bad, no matter what. All right. Another question, number 5, also asks about things that you can diversify versus things that you cannot. Number 6 asks about stock splits, and actually 7 does too. So you'll want to read a little bit about what a stock split is and how it impacts investors. If I have a stock today that's worth $20 a share and they announce a stock split, a lot of people get excited. They think stock splits are going to make them a bunch of money because you might go from having 1 share to 2 shares, right? Which sounds good because you got more shares. The problem with a stock split is the day that they actually execute the stock split, they'll announce it before, but when they actually execute the stock split, it cuts your stock into 2 or 3 or 4, depending on how many the split is. But it also cuts your value by that same percentage. So if it's a 2-for-1 stock split, that means it's going from 1 share to 2 shares, right? But if the stock today was worth $40 and after the split, it's going to be worth $20 a share. So if I have 2 shares, I still got my $40, right? So it doesn't change. That's chapter 6 in the slides. Stock splits, okay? But it might be nice on stock splits, because there's a couple questions on the test and we didn't cover it for a lot tonight, to kind of freshen up on what stock splits are. I'd maybe go to Investopedia and kind of learn a little bit about stock splits. And remember what I just said, which is if a stock splits and it's a $40 stock and it goes from 1 to 2 shares, I'm still going to have the same $40 that I had before. I've just got 2 stocks, right? Novena, you're exactly right. It just divided. It didn't give me any more value. It just gave me more shares. Okay? So make sure you understand what stock splits are and what happens when stock splits happen. Number 8 on the test is false. Okay? Number 8 on the test is false. Yay for being here and taking notes. Number 8 on the test is false. Number 9 on the test is asking about rights offerings and public offerings. Okay. So what does that mean? It just means when a stock is already trading, how does a company like GE that's already trading or Google initiate new stock issuances? Well, what they do is in a public offering or a rights offering. So those are ways, public offerings and rights offerings are ways that an existing company that's already traded in the stock market issues new stock to the public. Okay? So make sure you understand what public offerings and rights offerings accomplish. It's for an existing company to add additional shares of stock onto the market. And why do they do that? Because it makes them a lot of money. When they issue new shares, right, and put those into the market, it allows them to raise more capital, okay, raise more money. Number 10 on the test, you'll want to understand the general trajectory of the market. We talked about 60 years of the stock market. You'll recall that the average over the last 60 years was an 11% return, total return with both dividends and value, right? And so if there's a question on the test that asks about the general direction of the market, the general direction of the market is great, right? It can have bad periods, but you can go back 80 years and still the trajectory or the general direction of market investing has been very good. Okay, so keep that in mind for number 10 on the test. Your question about rights offerings, is that internal and is the public external? Rights offerings usually are internal and they're usually private. You know, you'd offer it to either employees or you offer it to certain investors, usually on a kind of a one-off situation. Public offerings, you're exactly right, is something that you do external to your company usually, but both of them, I mean, both of them can be either or. It's just generally exactly what you just said. Novena, shares can be issued initially in the form of an initial public offering, right? We talked about IPOs. So when companies go from private to public, they have what's called an initial public offering. Their stock becomes public instead of being private like it was before. We talked about how Uber, the company Uber, is a private company. When it goes public, it'll have what's called an IPO, and then it will be a publicly traded stock, and we all can invest in it. Right now, we can't invest in it because it's a private company. So that's an initial public offering, and that is how companies get started on the exchanges. That's how they start trading. Then after you get started, you can still do new public offerings, additional public offerings, or rights issuances after that too. But the initial one is always an initial public offering or IPO. Okay? Good question. All right, those are the 10 questions on the test. Any concerns or questions before we wrap it up for the evening? Appreciate y'all being here. Thank you for your participation. Thanks for not falling asleep too many times tonight. I felt like it was a good session. There's a lot more material here than what we covered though, so I encourage you to poke around on the slides, do a little bit of research on Investopedia so that you feel really comfortable before you get to the test. Have a great night. Good luck this week. Let me know if you have any questions or concerns. Just send me a quick email, and have a good one. Good night.